I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello and welcome to our weekly video. In this week's video, which has no accompanying table or chart, by the way, we're going to talk about capital gains distributions from mutual funds. So we've been having year-end tax planning discussions with several clients, and as part of that, we noticed in many cases that capital gains distributions from mutual funds are going to be much higher this year than they were last year. Now, there is a perception that some have that we don't have to worry about capital gains until we sell. And that is true for individual stock holdings. If you've held Amazon for many years in your portfolio, you haven't paid any capital gains taxes on the very substantial increase in the price of that stock, unless you've sold. However, it is different with mutual funds. When mutual fund managers sell some of the stock holdings that have increased in price and there aren't enough capital losses to offset these gains, those gains are distributed to shareholders, typically in December each year. So while you haven't sold any of the shares of the mutual fund, you are collecting and realizing capital gains. So one way to avoid ever having to deal with the tax consequences of capital gains distributions is to hold these mutual funds in tax-deferred accounts like 401ks and IRAs. But the reality is that investors generally have a mix of tax-deferred accounts and taxable accounts. In those taxable accounts, you can reduce your exposure to year-end capital gains by investing in index mutual funds, ETFs, or near index or kind of quasi-index mutual funds with low turnover within the fund. Do not hold actively managed mutual funds. That's where you see more turnover within the funds. So the more turnover, and by that I mean more trading, it's more buying and selling that the portfolio managers are engaging in, then it's more likely that capital gains will accumulate and then have to be distributed to shareholders. I would say it's a happy coincidence that here at HFG Trust, we also like index mutual funds, ETFs, and quasi-index mutual funds, which generally have low capital gains distributions. So let's say that you do have a sizable taxable investment portfolio and you are set to receive a chunk of capital gains this year from those mutual fund holdings. The question is, will these long-term gains bump your ordinary income into a higher marginal tax bracket? Is that a risk? No. Long-term capital gains are stacked on top of ordinary income and taxed at lower preferential capital gains rates. But it will increase your AGI or adjusted gross income, which can phase you out of certain deductions and tax credits. And depending on your life stage, it could even result in you paying more Medicare Part B and D premiums in the future if your AGI exceeds certain thresholds. So there are ways to screen mutual funds for their tax efficiency and to know in advance if a fund is going to make a large capital gains distribution, so you can delay buying it or avoid buying it altogether. You probably wouldn't want to buy such mutual funds in December, right before these distributions are made, because you'd have to pay capital gains taxes even though you didn't necessarily benefit from the increase in value of that mutual fund over the course of the year. Buy it in late December or early January if you must. That's it for now. Give us a call if you have any questions. Thank you for watching. We'll see you next week.